Something unusual is happening in the silver market tonight. Prices aren't moving slowly. They're collapsing in a way that makes charts look catastrophic. Just hours ago, silver traded near 83, and now it's approaching $74. This isn't the result of news or economic fundamentals. This is a mechanical event, precise and brutal. The kind of move that shakes traders awake at 2 a.m. Eastern Time. The retail investor is asleep. Pension funds are on holiday. Only algorithms are active. A massive leverage position has breached its margin limits. In the institutional world, that triggers an automatic liquidation. The risk engines don't care about support levels or fundamentals. Their only job is to sell until the account is solvent. As the first orders hit the market, the price drops instantly. Buyers are almost non-existent. The order book is paper thin. The price slips $1, then $2, then $3 within minutes. This is a liquidity cascade, a self-reinforcing waterfall of selling. Every algorithm, every dealer hedging position is now compounding the pressure. This isn't a correction. It's a forced exit of a massive position. The magnitude of the move is magnified because of the time, ghost week, overnight. The first signs of panic don't appear in headlines. They appear in the tape. The red candles grow longer with each successive trade. It's almost as if the market is empty, like a ghost town. That's because it is. Liquidity has disappeared. Without buyers, the automated systems keep selling, searching for the next bid. $80, $78, $76. The numbers drop like dominoes. By 2:15 a.m., silver finds a temporary floor at $73.72. But that floor is artificial, created not by human traders, but by systemic intervention. This is not a reflection of silver's intrinsic value. This is a reflection of the fragility of the paper market. The margin call wipes out a whale's position in minutes, and the impact cascades into other parts of the market. Options desks face negative gamma. Hedging forces them to sell further. The paper market turns into a feedback loop of mechanical selling. Every dollar drop triggers more selling from banks and dealers. It's a robotic system chasing its own tail, creating the illusion of panic. But outside the automated chaos, the physical market remains resilient. Buyers in Asia continue to value silver based on real demand. The West experiences a flash crash while the East stays grounded. The contrast between paper and physical markets becomes evident in minutes. And the retail investor, if awake, can see the artificiality of the move. This is the opening chapter of a story where leverage was flushed, weak hands removed, and a market reset was initiated. As the forced liquidation hit, another layer of chaos unfolded. Market makers and options dealers suddenly faced negative gamma exposure. For every dollar silver dropped, they were forced to sell more to hedge their books. The selling pressure intensified, creating a robotic feedback loop. Prices dropped faster than any human could react. 76, 75, the numbers fell like a waterfall of red. This isn't a reflection of demand or supply. It's mathematics in motion. Every automated system amplified the initial shock. The paper market became a vacuum, pulling prices downward into a spiral. Algorithms didn't care about support levels, moving averages, or technical indicators. Their sole instruction, sell, sell, sell. Retail investors were still asleep, completely removed from the chaos. The leveraged whale had no choice, and it was wiped out. Banks and dealers, hedging options had to follow suit, magnifying the drop. The market looked like it would never stop falling. Every attempt to stabilize the price failed because liquidity was absent. This is the dark side of an ultra-thin overnight market. The mechanical selling didn't pause for logic or reason. The first red candle on the chart is terrifying, but the story goes deeper. It's a systemic event, a perfect storm of leverage and algorithmic execution. And then the emergency intervention kicked in. At around 3:15 a.m., billions of dollars of liquidity were injected into the system. Clearinghouses were at risk. If the whale defaulted, the system itself could fail. This injection didn't buy silver. It stabilized the plumbing of the market. Suddenly, bids returned. Algorithms paused. Dealers stepped back in. The fall slowed and finally found a floor at $73.72. But the retail investor still hadn't participated. This floor wasn't natural. The West had experienced a synthetic crash. Paper positions had been flushed. Meanwhile, physical markets in Asia ignored the panic. Shanghai futures held strong, near $89 per ounce. The gap between paper and physical markets now exceeded $14. This is an extraordinary divergence, showing that the crash was a paper-only event. Retail buyers who woke up saw opportunity, not fear. Inflows into silver ETFs spiked. Bullion dealers reported record traffic. The forced liquidation created the illusion of panic. In reality, it cleared weak hands and left strong hands in control. The stage was set for a rapid recovery once institutional desks returned. The mechanical chaos ended, but its effects reshaped the market. Leverage was flushed, risk exposure recalibrated, and weak positions removed. The overnight event was not the end. It was the reset. While New York and London were in turmoil, Asia was watching closely. Physical silver remained scarce and industrial demand continued unabated. Shanghai contracts closed at $89 per ounce, untouched by the overnight crash. The $14 premium between West and East is unprecedented. Arbitrage cannot close the gap due to export restrictions and supply bottlenecks. The paper market reflected panic. The physical market reflected reality. Retail investors in the West started noticing the disconnect. The narrative of retail panic was a misdirection. In fact, small investors were buying the dip across multiple platforms. ETFs saw significant inflows. Bullion dealers reported record orders. The over-leveraged whale had been liquidated. Weak hands were removed from the system, leaving only committed buyers. Physical withdrawals from COMEX vaults spiked. Over 600,000 ounces were removed before the crash, indicating awareness of paper suppression. The physical market acts as a truth teller when paper prices lie. Silver stacked in strong hands is no longer subject to mechanical liquidation. The West has empty shelves. The East is accumulating metal. This explains why Shanghai premiums remain firm despite the paper collapse. The market is split between synthetic chaos and tangible scarcity. Retail buyers now have an advantage, holding physical silver at depressed paper prices. The 73-72 floor was artificial, propped up by liquidity injections. The $34 billion emergency liquidity was a floor for paper, not metal. The West is patching the system. The East is hoarding assets. This divergence signals a potential massive correction when paper and physical converge. Smart money recognizes the opportunity. The retail investor can also capitalize. The crash reset leverage and cleared weak hands. The Shanghai premium confirms that true demand is intact. Industrial buyers and sovereign wealth funds are quietly accumulating. Silver's real value is now revealed through scarcity and strategic positioning. The paper price is a narrative. The physical market is the reality. Retail investors should ignore panic stories and focus on actual holdings. Forced liquidation events don't reflect market fundamentals. They reflect over-leverage and thin liquidity. Once the institutional desks return, the market will reassess the true value. That reassessment will likely be rapid and aggressive. The gap between $75 in New York and $89 in Shanghai cannot persist forever. The market is primed for a convergence that favors physical holders. This is a textbook example of paper versus physical divergence. The West's paper crash is an opportunity for long-term buyers. The stage is set for a dramatic rebound once the market normalizes. As institutional desks return, the market faces a unique reset. Weak hands are gone. Leverage is reduced. Retail investors who held through the crash now hold the lifeboat. Physical silver remains scarce, especially in Asia. Shanghai premiums remain firm, signaling real demand. The $14 gap cannot last. Arbitrage and institutional flows will start closing it. The first trades of January the 2nd will likely trigger rapid buying in the West. Retail buyers who stayed strong are positioned to benefit. The paper market has been cleaned of over-leveraged positions. Dealers and banks are recalibrating risk and inventory. The crash has exposed systemic fragility in paper-silver markets. The Fed and clearinghouses successfully prevented a collapse. But they didn't alter physical scarcity. They only stabilized paper. Industrial demand remains unchanged. The physical market continues to accumulate. The narrative of retail panic is entirely false. Data shows small investors were net buyers during the crash. Emergency liquidity was a plumbing fix, not a market fix. The crash created a buying opportunity for disciplined investors. Leverage has been flushed, clearing the path for a healthier market. Physical accumulation in Asia continues undeterred. Retail investors now hold the asset at a discount relative to global value. The paper price at $75 does not reflect the metal's real value of $89. Institutional capital returning in January will likely accelerate the rebound. The slingshot effect is ready to launch once desks reopen. The market is cleaner, lighter, and more resilient after the forced liquidation. Every ounce sold by the bankrupt whale is now in strong hands. Weak positions were removed, risk exposure is reduced. Retail buyers now control a meaningful portion of the market. The stage is set for volatility. But this time it favors buyers, not sellers. A rapid convergence between paper and physical prices is imminent. Silver's real value will be recognized once market forces align. Historical data shows that after forced liquidations, rebounds can be sharp. The combination of physical scarcity and institutional buying creates a perfect storm. Retail investors who hold are now part of the strongest side of the market. The $34 billion liquidity injection ensured stability, not a price floor. True market strength lies in physical holdings and committed investors. The next 48-72 hours will reveal the speed of the recovery. Investors who stayed calm during the crash are now poised to profit. The West and East are no longer in sync. Convergence is inevitable, and when it happens, the silver market will show its real strength, rewarding those who held through the storm.